Good afternoon, everyone. For those of you who don't know me, my name is Asa Good, and I'm one of the Associate Directors for the Center for Food and Agricultural Business here at Purdue University. And I am so excited to be kicking off our second tailgate talk with our guest today, Brady Brewer, who is on the faculty at Purdue in our Ag Econ department and works closely with the center, helping to direct our research initiatives and is working on a lot of things, which right now, though, one that might be top of mind in terms of interest for many of you on this is our large commercial producer survey, which will be launching in early January of 2021. So our research team is really busy right now working through the questions and preparing for that launch. And so I know that's one of the big things on his list. And we also have special guest, David Widmar, who's with us from Ag Economic Insights. David is a longtime friend of our department in agricultural economics, but also the Center for Food and Agricultural Business as well. And I'm really excited about this one because of the dynamic between the two of these guys. And so for our Tuesday tailgates, we like to log in a little bit early, make sure technology is working. And I'll tell you, these guys are both from west of the Mississippi. And so things are a little bit different probably than for how I grew up in just the middle of Indiana. And so the stories that they have been sharing are quite interesting. And I won't get into all of that, but I would add to David's resume, and I've learned this just today. I've known David for about 10 years, but he, in the early 90s, he and his brother were chicken chasing champions at the Dixie Stampede in Branson, Missouri. And, I don't know if there's anything that you're going to do in your career, David, that is going to top that accomplishment. So
I peaked early.
Well, so what we have kind of set the stage and asked these two to do is really just have a dialogue and discussion about finance as a big umbrella, but really looking at the farm economy. And so they have some key topics that they're going to kind of talk through and throw up and give their perspectives. But I would encourage everybody to utilize the chat function if you have a question. But at the same time, I think if we stay under that 50 mark in terms of participants, I think it's fair if you want to unmute and ask a question. I know they are going to try and, if we can keep them from, at least maybe I can wave and get their attention, that they might take a breath and let some questions come from the audience. So with that, I am going to turn it over to Brady and David, and let's have a great discussion.
Thank you, Asa. And I guess I'll introduce myself real quick, a little bit more in depth. So as Asa said, I am faculty of the Department of Agricultural Economics and work closely with the Center for Food and Agricultural Business. I grew up on a wheat and cattle farm in Northwest Oklahoma. And then Oklahoma State and Kansas State was where my degrees are from. And I spent a couple years at the University of Georgia before moving here to Purdue, where I've been faculty for almost 3 years now, I believe. I do want to reiterate what Asa said. We want to keep this very informal. This is, the name of this series, the Tailgate Tuesdays. Just imagine this is two farmers coming together at a tailgate late on an afternoon to discuss what's happening. And that's how we want this to be. So we actually we have some slides prepared, but we're not going to show them because we want to keep this informal and just keep this as a dialogue with what our opinion is and what we see going on. But with that said, if you have a question, chances are someone else out there probably has that question too. So we really do encourage you to speak up, either unmute yourself, interrupt us, get Asa's attention through chat, and get your question because, again, if you have that question, chances are someone else does as well. So with that, I'll pause to let David introduce himself further.
Well, it's great to join you all today. Spent most of my career working with these folks, and so it's great to be back on to chat a little bit about my observations and what I've been thinking about as Brady and I were preparing for this. I think we have a lot of stuff to cover, and we're going to have a lively discussion, and we want to hear your questions and your input. I've known Brady for a long time, and I'm looking forward to having this conversation. So I grew up on a farm in southeast Kansas. We raised corn and soybeans, double crop soybeans, and wheat as well. So anytime you get a true Great Plains wheat farm kid with another true Great Plains wheat farm kid, you're going to have an interesting conversation. Yeah, we're from the other side of the Mississippi, so we have a little different perspective, but it's been great to work with these folks to put this together. So looking forward to the conversation today.
So David, I guess let's just get started. And, I think in terms of topics, one of the things that is hot in my mind right now is as we see all that's happening, and we'll get to the full laundry list of everything that's happening in the farm economy, but really where I start is working capital. Burn rates, all that stuff. When I talk to, so part of my job here at Purdue University is helping the ag bankers and farm credit with training and stuff like that. And when I talk to them, working capital is really one of the main issues that comes up. What's happening with that? Are farmers using up liquidity that they have? Or, is farm income going to be bolstered enough? Are we going to see a rebound in prices to maybe add to the balance sheet and improve their liquidity position? A lot of what I've seen right now is the burn rate, right? We're seeing a rundown of working capital as farmers haven't had adequate cash flow. And that's really a concern from the banking sector of how's that going to play out and how long is it going to last?
Yes, I should give a bit of a background. I co-founded Ag Economic Insights. AEI.ag is our website about 6 years ago with Dr. Brent Gloy, and he's now back on his family farm in southwest Nebraska, again, back to the Great Plains here. But we have a weekly blog, among some other things, but in our weekly blog, we share sort of what we're observing as we look at the industry. So back in February, the USDA came out with its first net farm income estimate pre-COVID. And so there's a lot of headlines that said, hey, farm income is going to be up. This should be good. And farm income has trended higher since 2016. We peaked in 13, started to fall in 14, hit a low in 16, and then we've been trending higher. And so that was the first post we wrote. The week later, we followed up and said, but it's not all positive. And if you look at some of the balance sheet measures, which is what you talked about, Brady, is working capital has been continuously eroding. The second part of this is we've been continuing to add debt. And we would expect producers to burn working capital and add debt. That's how you build some runway when you don't have enough income in a given year. And we expect that to happen when we see the initial price decline and the initial farm income slump. We haven't seen this give up yet. We haven't seen any improvement to the balance sheet. So while the income statement, at least at the top line, is showing some improvements, the balance sheet is showing some weakness. And so I had concerns, and we had concerns internally, and Brady and I have talked about this at the beginning of this year, that it's not necessarily is income up or down. That's not the main headline. The headline should be, we apparently don't have enough income in the sector. A lot of farms don't have enough income on their operation to meet all their obligations. So what is farm income used to do? Well, farm income is used to meet family living expenses. So we got to take family living out of there. We also have to service debt. We also have to make, and that's the other big bucket, is servicing debt. And when you see debt continuing to increase, that was sort of helped us bridge the gap in 16 and 17, but we're still on that pace. And it's a tricky treadmill that we're on. We are, the balance sheet is working against us, and that's a challenge.
Well, and you mentioned the debt increasing. If I had $1 for every time I've heard, are we experiencing another 1980s type crisis, right? Where we see this bubble in the ag credit markets, debt goes up, and then everything collapses. I've heard that a lot over the past 3 or 4 years, going back to 2016. In 2016, when you look at the USDA numbers, that's really where we bottomed out in net farm incomes. We've actually seen increasing net farm income over the past 4 years from an aggregate level in the farm economy. Now, you do have to kind of put some asterisks on the past 2 years because MFP payments and now the CFAP program are going to represent a pretty large chunk of the income statement for farms across the U.S. over the past couple of years. And that's a really concerning a point that a lot of people are trying to make, is that without these government programs that have kind of stepped in and filled this void, farm income would have seen a very sharp decline in 2019 and here in 2020. But we haven't seen that with those programs. Farm income has has increased from the previous year, which has kept a lot of stuff increasing. And to me, one thing you mentioned, the burn or the balance sheet staying up there. One of the main drivers of that is farmland values. Farmland values, there was a lot of talk coming off the highs of 2013 and 2014 of our farmland prices going to decrease. What's going to happen there? And making those parallels back to the 1980s. And so far, we've seen farmland prices pretty much stabilize. Some areas of the country have seen a little bit of a decrease, 5-10%. Maximum in some really localized regional spots. But overall, they've stayed steady. This has kept the balance sheet up. And those cash flow shortages that you mentioned, where farmers haven't been able to fully bring in enough revenue to cover all their expenses, they've been able to take any shortfalls, collateralize them, turn them into long-term debt, which, when I talk to the bankers, that's something I always advise against from a long-term strategy. If the farmer's not going to have the short-term cash flow, I'm always really cautious in taking that and collateralizing it, turning it into long-term. That's by and large what we've seen happen, because the farmers have had such a strong balance sheet position. From a risk standpoint, when you look at the solvency, not the liquidity, the solvency, so debt to asset or debt to equity, they're in a strong position. So that's what the bankers have done up to this point.
Yeah. So, Brady, I'm an economist, and so I just can't. You went through a lot of really good stuff right there, and I have, Brent and I have written many 1,000-word blog posts about each of those things, and so I'll provide just a few comments about what I captured from what you said. I agree with everything. The other thing I'll share is that I'm going to share some links with the CAB team, and they're going to provide some show notes at the end of this. And so if you want to dive into anything that I reference, and Brady's going to share his reference points as well. Farm debt. I mean, it's really interesting if you think about human behavior, because the first thing people ask, like, oh, is this another 1980s? So it's trouble in the farm economy. We try to draw a line to the 1980s. And the first lesson we want to take away from the 1980s is the debt to asset ratio. And so a lot of times this debt to asset ratio comes up as like, oh, we're not at 1980s levels. Cross this off. We're not like the 1980s. And so my co-founder and I, Brent, we spend a lot of time thinking about the 1980s and lessons that we should be learned. We're actually, thinking about how do we create a new project to help people think about that. But there's an entire book out there that's written on the 1980s, and the balance sheet is at most one chapter. So don't just focus on the debt. But with that said, farm debt in the U.S. has trended up. It's approaching some 1980s levels. So some headlines are going to be out there saying that. I want to point out one big difference is that today we have a lot of real estate debt, and we have a much smaller proportion of non-real estate debt compared to the 1980s. And so that's a huge difference. That's a different debt structure. So I think that's really important to point out. The other thing I want to say about farmland is one of the most underappreciated economic drivers in the farm economy over the last decade has been lower interest rates. We've been writing blog posts for a long time. And if you go back to 2010, one of the first things that came up in 2010 was that one of the big stories from 2010 was that farm interest rates had ticked lower. And it was a big boom for the farm economy. Well, guess what? Farm interest rates in 2010 were the highest they were for the entire decade. Okay, so we have seen nothing but declining farm interest rates. And oh, by the way, it's been going on since the 1980s. Okay, this decline has been going on for most of our entire lives. Why is this important to the assets and the balance sheets? Well, a lot of times we think about interest and how much it costs for us to service that debt. That's one element. I think it's a small piece of the puzzle. The bigger piece here is asset valuations. And so when we have low interest rates, it tends to push capital asset values higher. And we've seen this in farmland. We'll see it in the broad economy. And I don't want to get into all the details of that. But low interest rate environment has been extremely helpful for the farm economy, especially over the last 5 or 6 years during the downturn. We've looked at this in a lot of different ways. If you look at the decline in revenues or the decline in profitability from the early 80s into today, we've seen about the same decline from the 1980s to today in the value production, right? These are big macro level numbers, okay? Not anything that any specific farm is going to go off, but the shock to the income statement was about the same. But farmland values haven't dropped like they did in the 1980s. What's the big difference? Interest rates, okay? And so we were in an environment in the 1980s when interest rates were going up, and when interest rates are going up, that's going to pull farmland values down. And so we've been in a low interest rate, very helpful for farmland values. And so, Brady, you're looking to get in there, but before we move on, I want to make sure we put a pin in government payments because I want to make a point about government payments. But I think you have something to say here about interest rates and farmland values.
Well, I was just going to make a point that it's really interesting to me when you look at the interest rate numbers. To me, it's pretty unfathomable to think that interest rates back in the 80s were at 18% for some ag loans, right? I mean, that's something that, I'll never say never that we'll get back to that, but just the big difference in magnitude of how that affects the income statement. Well, it doesn't affect the income statement for the interest, but in EBIT it does. But, just the cash flow side of that, 18% versus 5% is such a big difference, right? So that's, you mentioned the downward pressure, but we're talking tripling of interest rates from now to what we saw back in the 1980s. And that's one of the big reasons why you saw what you saw back then is it was really a perfect storm of the banks, the risk of the banks, the downward pressure of the commodity markets, and the upward pressure of these all-time high interest rates. So I just want to make that key point of the magnitude of difference between the interest rates back then and what we see now.
Yeah, I mean, we could spend the whole hour episode talking about interest rates and how it goes into valuing farmland. But you really have to keep in mind when you have, if you're going to get cash rent off this farm, which is how we sometimes think about farmland values, get $200 an acre in cash rent and the interest rates are 2%, and you get $200 an acre and the interest rates are 10%. I'm not even going to 18%. I'm just saying 7 or 10%. You're going to value that farmland at a much different place, and the low interest rate environment is a high capital value. So here we are in 2020. I just wrote an article 2 weeks ago about government payments. So here are a couple numbers to keep in mind. $35 billion in 2020 dollars. So that would be a record for direct payments to producers. We saw a spike in direct payments back in the 1980s. We saw them in the late 90s, and we saw them in the early 2000s. We'll share the link to that story for you, but those time periods I mentioned, about 5 years in those 3 periods, we saw direct payments approach $35 billion in inflation-adjusted 2020 terms. Right now, my back-of-the-envelope calculation says we're at $30 billion. And so here in 2020. And I think one of the questions that we're thinking a lot about within some of our work is we're asking the question, will we exceed $40 billion in direct payments here in 2020? I don't know, but I think there's the potential for another round of funding. And the reason why I say that is that we don't have a round of direct payments, a program in place for the crops raised in 2020. That CFAP program does not address crops in the ground growing right at the moment. And so I think that there's a lot of road signs, right? But that's the big one. The other one is CCC is going to get more money here in July. And oh, by the way, they're talking about another stimulus bill. So why am I bringing this up? Well, we've been trying to help producers think about that. And the challenge with MFP for 2018 and 2019 and CFAP is that these are ad hoc programs. So the Farm Bill's out there. It has the ARC PLC program, and that's the traditional Farm Bill's been generating 12 to 14, maybe $15 billion in direct payments, right? We don't have a Farm Bill in place that allows for a mechanism to kick up when we have trade wars and demand shocks, adverse demand shocks from COVID. And so we're relying on CCC and congressional activities to create this ad hoc funding mechanism, which is very helpful in the short run. But what can we expect down the road, right? Sonny Perdue, the USDA was saying in 2018, there will be no MFP program in 2019. Well, here we go out to 2019, we got an MFP program, and they spent all 2019. There will be no MFP program in 2020. Okay, well, we didn't get an MFP program, but we're going to get a different ad hoc program. But the important thing is there's nothing in here that you can plan for 2021. So if you're looking at the crop budgets for 2021, it looks like a disaster. There is no mechanisms in place. And so we're trying to help producers think about, okay, what was my financial performance in 2020 or 2019 or 2018? Now let's think about what role ad hoc government payments played in my financial performance this year. And so we kind of have to recognize that I might have had an okay year or a rough year, but if we start to take out those MFP payments and those CFAP payments, those ad hoc programs, that sort of tells us the kind of a different level, a different measure of how challenging the farm economy is, because we have no plan. We don't have a program on the books to help the crop that's growing right now with respect to an ad hoc program. Yeah, and that makes it really hard for producers to plan and make projections and make financial decisions. And we don't have a program in the books for 2020. I think there's a good shot we'll see one. We have nothing for 2021. And the problem, okay, here I'm gonna get my rant. The fundamental problem is not income. Income is the symptom. What is it a symptom of? It's a symptom of low commodity prices. Why do we have low commodity prices? We have too much ending stocks, okay? The ending stock situation is supply and demand, and we have two bad demand stories. So at the end of the day, it's an ending stock problem. It's a demand problem. And direct payments are really good at helping the symptom, which is low farm income. Unfortunately, the problem is, it's like a dam, right? And we're putting more and more water behind this program. And so I don't know what we're going to see going down the road, but we have to keep that in the back of our mind.
Yeah, our colleagues at the University of Missouri at FAPRI, the Food and Agricultural Product Research or Policy Research, they estimate 2020 farm income. So 2020 could see the lowest farm net cash income that we've seen in the past 15 years, which would put it right about $69 billion. Which to put that in perspective, back in 2012, 2013, farm income was up around $118 billion. So drastic reduction in just the net cash farm receipts. And then they put estimated direct or farm payments, government payments, right at about $32 billion in 2020 is what they're estimating. And they're right now estimating about $16.6 billion in 2021. I do not know, just disclaimer, I have not looked at how they are figuring that out, if that's just RPPLC, if that's another round of MFP that they think is coming down. I haven't looked at those numbers, but around 16.7 billion in 2021, which would put total farm income, once you do the government and total net cash farm income, slightly lower than what we would have here in 2020. So further reduction moving forward through the end of 2021.
Yeah, so my guess is 16 billion would be the ARC and PLC program kicking in, given the low commodity price environment that we're seeing today. Of course, keep in mind that the ARC and PLC program has a lot of problems, right? So the crop we're raising in the ground right now won't get paid until 2021. So that is probably a projection of what those look like. And so, yeah, so 16, 15, 12 billion is the farm bill. And we've been looking at this as a percent of income. So what percent of your farm income, what percent of the sector-wide farm income? Last year, a lot of headlines were made when we got to this $27 billion spent, or $25 billion, and about 25% of farm income. My numbers are a little fuzzy there, but a lot of attention got paid to those numbers a year ago, and we're going to definitely exceed those numbers. And I think there's a really strong possibility that we're going to see 35 to 40 plus $40+ billion in direct payments. And this is another way of measuring the challenge that producers are facing. We're in a tough spot, and it's in whole economy, and it takes time to make adjustments that are necessary in light of this.
And I just before we move on to kind of some of the external factors, and you mentioned this year's crop with the commodity prices, I want to touch on some of those topics, but I do want to make a point just from default and non-performing loan statement, that's something that I monitor closely. I've gotten some calls on it from some newspapers. This year we've seen the New York Times and the Washington Post and some major news outlets across the U.S. say, "Oh, farm bankruptcies have doubled." I still want to put the caveat on here is, yes, it's doubled, but it's went from 2 farm bankruptcies filing, the Chapter 12 to 4. So it's still a pretty minimal amount of delinquency that we've seen out there. Farmers have, by and large, been able to meet their obligations. I do a national survey with some colleagues at Kansas State and here at Purdue. We get bankers all the time saying, in my loan, in my entire loan portfolio, I have 0 farmers that are delinquent, right? 0 non-performing loans in my loan service territory. That's way more common. We have some depending on the sector that they operate in, if they're heavy on maybe the fruit and vegetable or dairy or something like that, occasionally we'll get a banker come back and say, yeah, I've seen a pretty sharp increase in the number of farmers that have not been able to meet their obligations this growing season. But by and large, the delinquencies have stayed down. And if you look at the Kansas City data, the Kansas City has their ag finance data book where they monitor ag-specific credit conditions. You look at the 30-year average, the 30-year bankruptcy rate in agriculture has been about 2.1, 2.2%, depending on what years you include. And we're still under the 30-year average. So from that perspective, it's, the sky is falling storyline that you get from some places, that's not something I buy into right now. Now, I do think everything that we're talking about, right, the lower farm incomes, the government payments, being a larger percentage of the farm income here the past couple of years. We haven't even mentioned trade war yet, so we'll get into that here in a couple minutes. But that's something that's going to affect us moving forward, and it's definitely cause for concern. But if you look at the past years, I tend to think of this farm income cash stuff as indicators that may go into this output of the bankruptcy equation. Definitely, the flags are being raised, but we haven't gotten anywhere to where we've seen a movement of anything that's showing up in the bankruptcy data. We're still below that 30-year average.
Yeah. So, you have to take a financial metric as one view of one thing, right? So I have this can of Dr. Pepper here with me, and farm income, right, is like one little square of this can. This can is a 3-dimensional object, right? We all know what it looks like. We all know it has a divot in the bottom and the hole in the top, right? But one metric is one evaluation of a very complex thing. So we have all these income measures, and that gets us one side. Then we have debt measures, and that gets us to the other side. And we have loan performance, and that's a measure to the different side. So as economists, it's easier for us to run through all these measures because we think about them in our head a lot, right? But the takeaway here for everyone on the phone is don't let someone summarize the farm economy for you with 1 or 2 statistics, okay? Especially if those statistics are in a short time period. I want to be a little more blunt than Brady was. The farm bankruptcy data is not very good. One, bankruptcy is sort of the end of the line, right? Yeah. Like that is sort of, that is measuring something that's already happened, right? So that is a very lagging indicator of what's going on, right? So I agree with Brady, the delinquency data that comes out of the Kansas City Fed, it's telling us a measure of performance, and that's a really good measure. It actually tells us a percentage of all the loans that are out there, okay? That bankruptcy data also has another problem. There's more than one way to file bankruptcy, and that only measures one of the possible measures. And what happened is they changed the farm bankruptcy laws not that long ago. They increased, there was a maximum cap. There's still a maximum cap that you could qualify to file under the chapter. It's eluding me right at the moment. Is it 14 chapter farm bankruptcy code? So there's a threshold. They changed it in the last 2 years. So earlier this year, when you saw that uptick in bankruptcies that were going in, filing under the farm bankruptcy plan, a huge part of that was that now more farms were eligible. Okay, here's the other thing that you see with the farm bankruptcies that Brady mentioned. They typically show 5 years of data, which is like, okay? If you zoom out to the delinquency data and you get a big enough set of the bankruptcy data, you will see that the last 5 years have trended the wrong direction, but we're not at territories that were concerning. And so he mentioned really greatly 2.2, 2.1%. We watch this metric very closely. We're below that number. We're approaching it, but we're below it. We spent most of the 90s above that average. We spent most of the early 2000s above that average. We started the downturn from historic lows. I want to make one more point. There's a lot of attention to farm loan performance in the last 5 years. But since the 1980s, take the 1980s out of the equation. When was farm loan performance the worst? The 08, 09 recession. Okay. Now that was mostly an off-farm income problem, but we saw that metric jump up really quickly, really fast. I think it got to 3.5%. So Brady told you it was about 2 on average. It got above that average, and it came back down. So one of the things that I'm concerned about here in 2020, in 2021, is not only does the farm sector, and the farm sector means all 2 million farms per the USDA's category, we have an on-farm problem with respect to low commodity prices and all the headwinds we talked about. And then there's a segment, a lot of producers out there rely on off-farm income to meet all their obligations. And now if we have off-farm income challenges that are sustained, that could be another challenge. And so both of these occurring at the same time could be problematic. And so we have to keep that in mind.
So I do want to turn our focus now to kind of this current growing season, what's happening in the farm economy, because you mentioned prices and stuff are the indicators, and what we see in the bankruptcy is the lagging indicator. There's a lot going on out there. Just quick rundown. We still got the trade war going on. The last numbers I saw was that China would need to increase about 67% a 67% increase in commodity purchases to meet their obligations in the phase one deal. The latest is I've heard some inflationary and deflationary concerns with what's going on. We've had a lot of monetary and fiscal policy happen over the last several months to combat the COVID-19 pandemic. So we have a lot going on in the general macroeconomy. So now we're worried about inflation and in some cases deflation, depending on which economist you talk to. Because of the slowdown and recessionary effects that's having on the economy. So there's a lot of macro factors going on. I do want to take a quick moment to just remind people, if you have questions, feel free to interject. We've gone over a lot of topics so far. We told you that this would be a fairly informal chat between two economists, and I think that's what's transpired so far. So if you have any questions, feel free to interject. Unmute yourself, interrupt us, or text or chat your questions to Asa, and then she will get them to us.
So I'm going to jump in on the trade war. I didn't see the number that you saw, but I looked at some numbers this week. I'll include them for your show notes. Basically, the data have come through since April. We have January, February, March, April. A third of the year is on the books, and China is running at pretty much 2019 levels. And that's disappointing. I think we're about 4.3 billion, and the record year, which over the last 5 years, I think it was 17. For comparison, we were close to 7 billion that year. Okay, so I think the big disappointment here is not. I think everyone was skeptical about us reaching whatever the phase one goal was. We put the number at more than 35 billion with some of the stuff we've been working on. I think 36.5 is the one. The idea was we had been around 25, 27 billion as the high. The idea of getting well above 30 was sort of the stated and implicit promise of phase one trade deal. So we got 4 months in the books. Phase one got signed in January. And you know what? We're not only not making progress towards a record, we're not even making progress to getting to pre-trade war levels. We're still in the trade war rut. And that is just a really challenging headwind for the farm economy. And there's a lot of moving pieces, right? But it's going to be tough. So there are some positive stories out there, right? If you dig into the data deep enough, and there's been a lot of stories about this. Exports of specifics, so pork, I believe beef, have been up a lot. But these are small things that have gone up a lot.
Yeah.
There's
and
also
on the grain side, I do want to point out sorghum has been a bright spot.
Back to the Great Plains reference, sorghum, right? I've raised some sorghum on my farm, as I'm sure Brady has too.
Yeah.
We know.
Or Milo, if you want to call it Milo.
Yes, Milo, the itchy crop that nobody likes. So yes, there have been commodities that have seen big increases, but it hasn't been enough to move the needle, and the needle is stuck at some trade war level. So now there is another line of media, of articles out there that say China's booking a whole lot for the rest of the year. That the new crop, soybean, the crop that we're growing now, they want to import it. So I believe almost 60% of all of our soybean sales happen in the last 3 months of the calendar. So yeah, we have a lot of backloading of trade with China to the back of the calendar. But we have to keep that in mind. So if China starts buying a lot of soybeans at the end of the year, are they buying a lot relative to early in this year, which was pretty flatlined, or are they buying a lot for a seasonal average adjustment? And so my point to this is there's going to be a lot of headlines about the positive stories. There's going to be a lot of headlines about the negative stories. We have to look at it in aggregate, and we have to really think about what's relevant. And so look at soybean activity. Look at the total activity. Keep in mind the seasonality of these purchases. So Brady, you mentioned the macro economy. If you look back to the 70s and 80s, the macro economy was a huge driver of what was going on then. It's kind of interesting how the macro economy has come front and center really quickly. And you mentioned inflation and deflation. And so there's, I guess, what does it mean to be in a times of uncertainty? The one that I always talk about is whenever a group of experts don't even know the direction or don't even know the sign. And so there are really smart people who are saying one of the big risks that face the economy for the next 18 months. The biggest thing that I have concerned about here today is where the economy goes over the next 12 to 18 months, right? And on one side, there's smart people saying it's inflation, it's prices getting out of hand. And there's a lot of things that they mention. On the other end of the spectrum, there's a really smart group of people who say it's deflation, it's prices falling. It's that pain that the farm economy is known about for a while. It's the idea that consumers aren't going to go to restaurants. They're not going to buy airplane tickets. They're not going to be buying new cars. And so prices start to come down. And I think that's how you know when you're in certain times is you don't even know which side of the bet to start.
Don't even know the direction, or we can't even forget about magnitude of the inflation or deflation. We don't even know which sign, is it positive or negative.
So I'll be honest, I'm a little bit on the inflation side of things. I have no idea. I will change my mind at any point. I will say I was much more concerned about inflation a month ago than I am today. So I've become a little more concerned about the economic headwinds that we've been facing. The economy restart. I mean, we have not ever restarted economy like we're trying to do. So I think there's this panacea out there that like, oh, one day we're going to unlock the doors and the economy is going to restart. That is something that just doesn't happen. And so I have been my concern about the pain of restarting the economy has increased in the last 6 to 8 weeks. This is something I'm changing my mind on about. I still think in the long run, I think about inflation. I worry about inflation. And it might not even be inflation in the next 12 months. It's how has the situation we face today, how is it, we shook up the snow globe, right? How does the snow play out over the next decade? And I think this is the type of event that we're in, is that it's going to have ramifications for a decade. So Brady, I want to ask you, deflation versus inflation. I'm a little bit. So if we had a scale from, let's say 1 to 10 and 5 is neutral, I think that's balanced. Okay. I am like a 6 on the inflation side. I'm a little bit to the inflation. So where are you on this spectrum?
I would probably say a 6 or a 7. The amount of spending that we've seen from the federal government from a macro perspective has been pretty unprecedented over these past 6 months. The trillions of dollars that's happened. For me, it's hard to believe that when the federal government ramps up and gets its engine going like that, and we've seen the spending that's happened at the federal level from that you're not going to see some type of inflation. The part that makes me really uncertain, though, is that if the COVID-19 pandemic really keeps people in their houses through the end of 2020 and into 2021. Because I mean, we all have friends and businesses that we hear of that, life isn't going to return to normal. Spending's not going to return to normal. You bring up the restaurant side, and that's directly affecting the food supply chain because that's purchasing the end product. But regardless, this all affects it because exchange rates, the strength of the dollar, obviously all this affects the world trade that we see on the agricultural sector. So, no matter what spending category we're talking about, this has agricultural implications. But if we see that slowdown in spending, that's where you start to see that recessionary effects counteract the spending effects by the federal government. So, and I think that's why we're so divided. It depends on what effect you think is going to be larger, right? Is the recession effects going to outweigh the spending effects by the federal government? I think that $1,200 for every person in the U.S. That's pretty unprecedented, and I have a hard time believing that that's not going to have some impact. There's a lot of economists believe that that's what's propping up the stock market. People took it and invested it, and that's kept some of the stock market afloat. We won't get into all those arguments because, again, we could spend 5 hours on that. But probably a 6 or a 7 on that question. I'm in agreement with you. I do think that it's not going to be a 10, and I think that's what if we get a bunch of experts say 10, that's where you would start to say, okay, inflation needs to be a worry. But any amount, a 5% increase in prices, that's enough to cause other countries to shift their buying patterns away from U.S. goods in the agricultural sector. Brazil soybeans have already seen an increase in exports of 50% from 2019 levels. So we're obviously seeing some shifting of these trade patterns, and any incentive you can give our trading partners to do it further keeps our commodity prices here in the U.S. Lower.
So on the last point, I'm going to add a quick one. If you want to really think about the macroeconomy, you have to think about exchange rates. And part of this thing that you mentioned to Brazil is that their economy is in a much worse situation than we are. Their exchange rate their currency's fallen out of bed. So I think a year ago, $1 would buy 4 reals. It bought 6 about a month ago. It's back down to 5. And so China can, one Chinese yuan can buy a whole lot of Brazilian soybeans. And we have a stronger dollar, and that's going to be a headwind for exports. I want to share an analogy about the economy is that sometimes, when someone gets sick, they get some medicine. Sometimes they stay in the hospital and they get some medicine. And sometimes we got to put them in a medically induced coma. And the economy in the U.S., I've heard a really smart individual, Howard Marks, mention that basically the protocol we've been in is we put the economy in a medically induced coma to fight the COVID situation. And in doing that, the stimulus is a response to this very aggressive procedure that we're doing on the economy. We don't have a lot of experience waking up the economy from the coma. So for a reference point, I always like to have reference points. The TARPS program, Troubled Asset Relief Program, that was highly controversial in 2008. This is the bailouts that we had in the last round. Any guess as to, Brady, do you remember how much that Troubled Asset Relief Program was back in 2008?
Not specific. I'm pretty sure it was under $1 trillion, and I'm pretty sure it was under
400 billion. It was in the 400 to 500 billion mark, right? And so the first stimulus package that the government passed was $2 trillion, and we've kept adding to it since then. And now the White House, I saw the other day, is looking for a $2 to $3 trillion stimulus package to come through. And so my point to this is that we've taken drastic measures. And so while I put on the inflationary side of the things I'm concerned about, the severity of the magnitude of the stimulus efforts, I think about the other side of the balance sheet or the other side of the ledger, and I'm saying the economy is in a really bad spot. And so if we don't get the economy woken back up appropriately, that's when you have deflationary concerns. And so it is a too hot and too cold paradox where I'm not sure how we ever get anywhere near the right amount of stimulus to balance all this out.
So we're running out of a little bit of time. We got about 15 minutes left before we hit the end of the hour, and I want to save time to talk about this. So summarizing this, how is this going to affect, the agribusinesses, the people that service the farmers here through 2020? Are we going to see an increase in risk of credit? Are we going to see, farmers, we know commodity prices are not going to rebound fully. The trade war, as I said earlier, China still has, they would have to increase purchases 60% even to get back, to get to phase one. And we probably don't even think they're going to get pre-trade war levels of buying. So that's going to further suppress it. I do want to mention, I saw, as of June 7th, I think it's 3.9 million acres of corn is in poor to very poor conditions, according to the USDA. We never want to see that, but if we do see some decrease of bushels from previous WASDE reports or USDA forecasts, that could cause a little bit of rebound of prices for those farmers that are able to have a corn crop. Probably not anything significant to what farmers would like to see for prices, but that could help in some areas. You mentioned that the ending stocks are a problem. Obviously, a drought or not being able to plant because of wet conditions will help draw down those ending stocks. But at the end of the day, if we don't have places to sell those commodities, that's an issue. So my take on this is, looking at the University of Missouri FAPRI estimates, farm income is only down about 5% in their baseline projections for 2021. I don't think, some of the issues we've talked about, the working capital, the cash flow, are there going to be issues? Of course, but I think it's going to be on a very farmer to farmer specific case by case basis. When I talk to farmers out in the field, there's farmers that even with the current commodity prices, they say, hey, when I put pen to the paper, I can still make positive cash flows. I've just got to be smart with my inputs, smart with my asset utilization, and it's going to work out as long as no catastrophic event comes along in this. So there's still positives out there. So I don't think there's going to be too much of an impact, but I do think that there's going to be some farmers that we begin to worry about because, at present, we've started to see farm income or net cash farm income decline now for 4 years. The MFP and CPAP have made it increase the past couple years. That's still concerning. The drawdown of working capital is concerning. Everything we've talked about, from the trade war to the interest rates to the inflation and inflationary concerns, are stuff that we need to monitor. So there's a lot of, your word of uncertainty, that's like the word of the day, right? Uncertainty is the word of the day because of all that's going on. And I think that that's going to translate into increased risk. So if you're a business out there that is a business partner with farmers, you need to be cognizant of that increased risk. But I don't think we're going to see any aggregate numbers such as bankruptcies or delinquencies, any of the lagging measures uptick over the next couple of years or so.
I'm a little more pessimistic. I looked at this, right? 22% ending stocks for corn. And how do we get here? Well, the deck is stacked against us, right? We have huge beginnings. We have 2 billion bushels in beginning stocks, and we plant 97 million acres of corn. And so we're going to get some more numbers, right? Everyone thinks that we're going to back this 97 million acre number up. I think we might a little bit, but I think we have to realize that there's a 50-50 shot of corn being above 20% ending stocks and below 20% ending stocks at the end of this year. If we had a 2012 like event in the West, which is really catastrophic, right? Because of the beginning stock number and because of the 90, we're basically going to plant the second largest corn crop in U.S. history, modern history, right? You can't undo those factors, right? Those are still playing into the math, and those mute any sort of downside yield potential. So the other thing is there are no alternatives, right? Wheat has been pushing its problems into corn and soybeans. Corn and soybean acres have been going up since 2014. Why? Wheat was in a really bad shape. Then we had the soybean situation that blew up and pushed more acres into corn. There is no good alternative. There's no crop that we can shift to. And so if you looked at 2020 and 21, we're still going to plant 90 plus million acres of corn. Uh, Probably 85 million. We are planting 180 million acres of corn and soybeans. We got to allocate those, right? So if we get 95 corn, we have 85 soybeans, and that's a lot for both of those crops here in the situation. We are getting by with a lot of direct payments, and I think when your producers start to make their budgets at the end of this year, it's going to be very sobering, especially if the commodity price environment that we're in today sustains itself for the next 6 months. That is going to be really challenging. And even if we have a shock, a weather event shock, it's not going to be as significant as we might like to think it is. Keep in mind, we had record prevent plant last year. We broke the needle off the chart for prevent plant, especially on soybeans, right? And we still have burdensome ending stocks. We didn't see a huge rally. So a couple things that I'm really thinking about is make sure we still have a couple minutes left is policy fallout. We have to really keep in mind that the policy implications of what's going on today, the macroeconomic situation that we're going on today, I mentioned this earlier, this idea of the economy restarting, that's going to be huge. So we couldn't get a farm bill passed in 2013. We had to do it in 2014. And that was because of the hangover from the last recession, right? And even when we got the farm bill passed in 2014, the ARC and PLC payments that producers were getting were subject to something called sequestration, which was part of this effort to reduce government spending. And that was up until 2018. And so for a decade, the hangover, so to speak, of that last recession was still playing out in the policies. And so we were really concerned about the deficit in 2011 and 2012 and 2013. And that played into the policies. So I think we're going to have conversation. I mean, if you think unemployment rates are hitting historic highs and GDP is going to fall, wait until the deficit numbers start to become, very obvious to folks. The deficit, the numbers I've looked at, we've blown through the deficit that we saw in 08 and 09. And that's with preliminary numbers. And so it's probably going to look very scary on the other side of this. The second thing I want to add is just because the Federal Reserve has lowered those target benchmark rates for the economy, that does not mean your operation, your business, or your farm customers are going to see lower interest rates on what they are facing. And so I think there's a big misconception that interest rates are going to continue to go lower. That's a huge positive. And I'm not saying they're going to go significantly higher, but we shouldn't be sitting around betting on interest rates to continue to go lower. There are some aspects of the economy that have already seen higher interest rates. So the Federal Reserve Bank shows the triple B-rated corporations, their interest rates are up. If you're trying to get financing for a fleet of commercial airlines with a contract to an air carrier, your interest rates are going to be unbelievably high. The risk there is huge. Everyone's going to be focused on the risk in the next 12, 24, 36 months.
Yeah, that is key. A lot of people think that just because the Fed has lowered the Fed funds rate, that all interest rates are lowering. And housing mortgage rates are currently ticking up right now, and that goes back to that risk word, right? Increased risk in the marketplace. That is a part of the pricing formula for the interest rates. Same in agriculture. I'm along the lines with you. I think interest rates on the agricultural level will increase slightly over the next year or two. We're obviously not getting back to the 18% we saw in the 1980s, but we could see, a couple, 100 basis point increase in interest rates. Some things that I'm thinking about, especially considering the COVID-19 pandemic and what we're going through, consolidation in the ag industry is something that, maybe not here in the short term, but I'm interested to see what this current economy is going to do in the ag industry, both at the farm level and up through the value chain, right? We've already seen it in some cases in the dairy side with DFA and Dean Foods. Will we see any of that? There's some major legislation and lawsuits coming down the chain in terms of in the meat supply sector. How is that going to play out? in lean times, you see people try to scale up to eke out any type of positive margin you can. So is there going to be incentive for companies to consolidate or merge to stay afloat? That's something that as a university researcher, I'm going to play out now. In 5 years, we may not see any of this. And my hypothesis that we could see some could be completely wrong. But typically, when you go through recessions, you see some consolidation. And I think that there could be some impacts there on the ag value chain.
Let me jump in there for a second, Brady. Here's another situation where we don't even know the direction of the sign. We don't even know the sign. So on one side, we're making calls. So one side is your idea that consolidation, which makes good sense, right? Yeah. But on the other side, there's policy calls and investigations about the idea of too much consolidation. And I don't want to wade in that debate, but in some sectors of the ag economy, we're in the ag food chain, we're talking about, is there too much concentration? And so this is another situation where the uncertainty goes both directions and we don't know how to frame that up.
Well, and that goes into the second thing I'm looking for is, one thing that COVID-19 has showed us is that the ag supply chain was built to be efficient, but not built to be resilient. And my colleagues, Jason Lusk and Nicole Widmar, that focus on the more consumer side of this, they, and when things are going good, that's a good thing because it means cheap prices for me at the grocery store when the ag supply chain focuses on efficiency. But when you have pandemics like this and extraordinary events, it means that you're going to have some issues and hiccups in the value chain. I think there is a whole lot of uncertainty around what are the impacts that businesses and farmers learn from what we're currently going through, right? Does this mean that we put emergency things in place that may decrease margins in the good times, but means that if we have another COVID-19 pandemic in 5 years or some other catastrophic event, that we're better prepared to get through that? And I'm completely ignoring the consumer side of what's going to happen with consumer preferences if people don't go back to the restaurants over the next year or two because people are worried about the pandemic. That further suppresses demand on the ag supply chain, which is going to be maybe not for the Midwest corn and soybean farmer, but for the fruit and vegetable farmers across the U.S. A lot of the fruit and vegetables and stuff like that are consumed away from home at restaurants. So that's going to put downward pressure there. There's just a whole lot of uncertainty around the COVID-19 pandemic and its lasting effects in the ag supply chain. And that's something that I'm going to be paying a lot of attention to because I think there's going to be some negatives come out of it that I hope we can diminish those negatives.
So Brady, one last thing.
And I feel like I just ended this on a really negative note, but it's something that we're all obviously paying attention to.
So one last thing I'll add here. How do we as decision makers get through this? And it's thinking about the toolbox that we have. What are the tools that we use to make decisions with? And how do we add to the toolbox and how do we sharpen the tools that we have? And so when we're facing the things that we're facing, we have to improve our thinking, we have to improve our thought processes, and we have to improve the information that we're getting in. And so if you're a decision maker, now is the time to really invest in how do I make better decisions? How do I help myself navigate this? And so there's a lot of uncertainty, but with that comes we need to step up our thinking process and we need to rise to the occasion. I think there's a lot of, of course, Brady and I would agree with this, right? And Asa and the whole CAB team, because this is what we do, right? We are fully invested in learning and helping ourselves and others learn. But I think this is just a really important thing to remember is that I'm so optimistic about agriculture in the long run. There's nothing about that. I think there's some challenges ahead of us, but we need to make sure that we know this environment that we're in and we make the right investments in ourselves. That's the highest ROI that you can have is an investment in yourself. And we got to make those investments today to help us navigate all the uncertainty before us.
Most definitely. So with that, we got a couple minutes. I do have one other point I want to get on, but I just want to remind people, if anyone has any questions about what we've discussed today, please feel free to unmute yourself or chat into Asa and she can get that to us, as we would love to answer that. And then on the COVID-19 impact, something else I'm thinking about right now is the issue of labor, right? A lot of our fruits and vegetables use the H-2A visa program to utilize that labor supply to get those products to the grocery store that we consume. You know, thinking about a lot of the U.S. fruits and vegetables, we're getting into harvest season of the fruit and nuts, you know, like peaches, and I'm thinking about peaches since I live down in Georgia, and stuff like that, and blueberries and pecans. It'll be really interesting to see how that impacts prices at the grocery store and supply of some of those products that we do produce here in the U.S., but we rely on outside labor to harvest or plant or whatever it may be in that production process. I think there's a lot of worried farmers out there that rely on that type of labor that may not have the supply they're used to on the labor side. So with that, Asa, I think we've rambled on for an hour, so I will turn it back over to you.
Hey, Asa, you're muted. This is the first time we've ever had this feature, Brady. We should keep this button.
Right? I know. Sorry, it doesn't last very long. So as I was saying, I don't know how good people are getting at reading lips as you go through all of these Zoom calls where people start talking before they unmute themselves. But I just wanted to extend a thank you to both of you for taking time and sharing your thoughts and providing some insights. As David mentioned, and Brady did as well, we'll be sending a follow-up with the recording as well as those show notes that direct to some of the pieces and information that they highlighted. Also, just want to make sure that everybody takes a look at the upcoming Tailgate Talks. In 2 weeks, we will have trends in purchasing behavior, which is a little bit of a discussion around some of the same topics and questions that we're thinking about for that large commercial producer survey coming up. And that's going to be with Dr. Brewer as well as Dave Downey, our Executive Director Emeritus for the Center and founder, who launched the Large Commercial Producer Survey over 20 years ago. And then we also have some micro courses if you're looking to refine some of those skills that are in very targeted topic areas, and those will start at the end of this month. So if there's any questions that you have as follow-up as well, you can email myself or any of our team, and we'd be happy to get those to our two guests today. So with that, everybody have a great evening and stay safe. Thank you.